When a geopolitical shock hits the physical map, the first invoice to change is never for the raw material. The marine insurance market reprices the underlying uncertainty weeks before the physical supply chain actually breaks. This specific mechanism turns the Strait of Hormuz into a master switch within the global billing system. In the next 12 minutes, I will show you how a narrow shipping lane forces a recalculation of corporate inflation trajectories, central bank rate schedules, and enterprise artificial intelligence budgets. Crude prices jumped aggressively this week across global exchanges. One market report captured a sudden 5.3% upward burst during trading hours. Another index framed the high-water mark closer to a 7% reflex at the peak. The exact decimal point matters less than the immediate demand for collateral that this volatility creates. Risk managers at major financial institutions do not wait for a tanker to take physical damage. They force an instant repricing of war risk premiums across the entire maritime sector. Hull coverage policies get rewritten by underwriters overnight. Cargo delay clauses trigger mandatory reviews within corporate legal departments. This represents the first layer of the corporate decision matrix. Underwriters sitting in London or New York sign off on the elevated threat levels. Automatic approval processes for standard freight routes suddenly require manual executive sign-off. The underlying mechanism here is entirely driven by financial plumbing. Commodity futures contracts enforce strict mark-to-market accounting at the end of every single trading day. That accounting standard demands immediate cash to cover expanding margin requirements. When massive margin calls arrive, liquidity vanishes rapidly from other discretionary corporate budget lines. The accounting reality dictates that working capital shrinks strictly to fund the expanding risk buffer. Financial surplus moves directly to the specialized syndicates selling volatility protection. The immediate cost is absorbed by logistics firms operating on razor-thin operating margins. Airlines managing incomplete fuel hedging programs lose their commercial bargaining power instantly. The second-order bill arrives next quarter packaged as a massive compliance drag. Legal teams must halt normal operations to audit every indexation clause and pass-through allowance in their vendor agreements. Dispute loops inevitably form between suppliers and buyers over the precise legal definition of force majeure. A baseline market report this week cited crude trading around $71.66 a barrel at one critical inflection point. That specific dollar figure functions as a universal input cost anchor for almost everything that moves across a sovereign border. Refineries cannot simply pause their massive industrial operations and wait for geopolitical calm to return. They are permanently bound by rigid delivery schedules, pipeline minimums, and unionized labor agreements. The procurement officer is forced to sign the inflated crude invoice to keep the facility running. The downstream pricing team subsequently adjusts the wholesale cost of the refined product. This automated process completely eliminates the option to absorb the financial loss internally. The cost placement shifts directly onto the heavy logistics and transportation sector. Immediate fuel surcharges hit regional trucking fleets without warning. Freight forwarders pass the unexpected variance directly onto agricultural equipment suppliers and industrial plastics manufacturers. The structural time delay built into this process is the actual trap for global monetary policy. Multinational companies reprice their consumer goods only when their existing 90-day purchase orders expire. They push the higher cost to the consumer when long-term vendor contracts finally reset. The inflation backlog clears slowly over a period of several months. The central bank is forced to watch a lagging inflation indicator print hot while real-time economic growth actively stalls. Holding interest rates steady strictly punishes a cooling domestic labor market. Cutting interest rates risks validating the new, elevated baseline for global commodity inputs. The liability for managing this macroeconomic stagflation pressure shifts entirely to the central bank reaction function. Bond yields adjust rapidly upward to demand a higher term premium from sovereign debt issuers. Equities reprice their internal discount rates to accurately reflect the compressed corporate profit margins. Credit spreads widen aggressively to penalize the most heavily indebted operators in the market. None of this financial chaos requires a single physical barrel of oil to actually go missing from the market. It only requires operational risk to be priced exactly as if those barrels might go missing tomorrow. This margin compression directly throttles the current corporate technology investment cycle. Chief financial officers do not halt artificial intelligence deployments because they suddenly doubt the underlying mathematics of neural networks. They throttle the deployments strictly because the enterprise contingency budget line must expand immediately. Enterprise artificial intelligence is not just a standard software licensing agreement executed in the cloud. It requires massive upfront capital expenditure for specialized hardware and dense server buildouts. It demands relentless, compounding operating expenditure to secure uninterrupted power and liquid cooling infrastructure. When energy input costs become politically volatile, the delicate operating expense models completely break down. The projected payback period for a new corporate data center stretches rapidly from 3 years to 5 years. When payback periods stretch beyond acceptable limits, the board of directors rejects discretionary capital requests. The procurement queue for advanced graphic processing units suddenly stalls at the enterprise level. Complex integration projects that lack an immediate, hard return on investment get deferred indefinitely. The structural bargaining power shifts entirely to energy vendors who can guarantee fixed-price utility contracts. Enterprises stuck relying on variable rate power agreements absorb the full financial penalty of the market volatility. This hesitation creates massive internal integration debt across the broader corporate landscape. Companies postpone their critical infrastructure upgrades but still demand aggressive productivity gains from their workforce. The broader labor market absorbs the resulting macroeconomic supply shock. Firms enact silent hiring freezes to diligently protect their dwindling cash reserves. Candidate queues for open positions grow significantly longer. Wage floors drop rapidly as the negotiation leverage moves definitively back to the corporate buyers of labor. Credential inflation accelerates simply because employers use advanced degrees as a free filtering mechanism for the massive applicant pools. Local municipalities face intense tax-based stress as payroll-linked revenues fail to meet regional projections. Geopolitics becomes tangible macroeconomic reality the moment the insurance invoice hits the enterprise procurement desk. In February 2026, severe internal debates surfaced regarding how a major technology firm's artificial intelligence model could interface with United States military operations. That specific corporate friction point reveals the final, crucial layer of the global budget reallocation cycle. Defense procurement remains the only corporate budget line that inherently and reliably expands during geopolitical tension. A single regional crisis forcefully tightens civilian discretionary spending while simultaneously loosening military urgency spending. The actual policy change happens deep inside the accounting departments of major defense contractors. Standard vendor scrutiny processes are frequently bypassed through emergency national security authorization clauses. Capital flows aggressively toward autonomous drone systems, threat detection logic, and secure battlefield communications infrastructure. The accounting reality concentrates immense wealth within established aerospace and defense syndicates. Civilian software-as-a-service platforms face elevated customer churn rates as enterprise budgets tighten. The second-order consequence is a permanently bifurcated global technology sector. Consumer-facing applications starve for dedicated compute allocation as hardware gets diverted. Military-grade data facilities command priority access to the strained national electrical grid. We can map the probable balance sheet pathways for the global economy over the next 3 quarters. If the optimistic scenario holds, The physical flow of energy commodities continues without any major interruption. The accumulated fear premium gradually amortizes out of the forward futures curve. Global insurers still capture massive financial surplus by holding onto their elevated rates for a few extra billing cycles. Low-cost energy producers maintain their leverage just long enough to lock in favorable long-term delivery contracts. Importers absorb a temporary supply chain cost spike, but successfully avoid permanent corporate margin destruction. The fixed-price service firms slowly recover their lost bargaining power as the input volatility dies down. If the realistic scenario holds, the physical disruption threat becomes a persistent, unavoidable operational baseline. Multinational companies entirely stop treating the geopolitical tension as an anomalous, temporary event. Corporate procurement teams bake the elevated maritime insurance premiums permanently into their multi-year vendor contracts. They standardize a significantly higher baseline for minimum working capital requirements. Financial surplus concentrates permanently in mega-cap firms that possess the market dominance to aggressively pass through all their operational costs. Small industrial buyers, independent shippers, and mid-sized employers permanently lose their ability to negotiate favorable terms. If the pessimistic pathway hits, the commodity futures market actively tests the extreme stress levels whispered by institutional energy traders. Spot prices push violently past the psychological barriers of $90 or $100 a barrel. Those specific numbers function strictly as mathematical stress tests to discover exactly which corporate balance sheets break first. At those extreme valuation levels, global inflation trajectories jump abruptly and persistently. Energy exporting nations and specialized volatility traders capture generation-defining financial surplus. Working-class households absorb the true cost of the crisis through severely degraded purchasing power and permanently frozen wages. Governments face severe sovereign debt pressure as they attempt to deploy massive emergency energy subsidies against rapidly shrinking tax receipts. You should aggressively ignore the political speeches and meticulously track the friction that forces corporate spending decisions. Watch the trajectory of maritime war risk premiums. Watch the specific shape of the commodities futures curve. Watch the credit spreads of the major logistics and shipping providers. Watch exactly whether enterprise legal teams start rewriting the force majeure clauses in their supply contracts. These mundane corporate metrics form the hidden architecture behind global liquidity. I follow the commercial invoices that make the geopolitical narratives real. Now you know what changed and who pays for it. This is After Hours Alpha. Subscribe for evidence-first takes on AI and markets without the hype. Like, comment, subscribe, hit the bell, and tell me the one variable you're watching right now.